Silver Dave here, and I'm coming to you for the crash part 2. So we have 4 series. This will be the 4th video in the machine learning series. Since I built a few models with machine learning trying to predict the price of gold, and we found some interesting things. Like, for example, it's not really able to predict the exact price of gold. Otherwise, that would be great and everybody would be really rich, but it doesn't do that. But what it does tell you is when things are not behaving normally and when you have strong external factors in the pricing of gold. So what are some of the strong external factors for the price of gold recently? Well, let's first talk about the crash, right? We can't ignore the fact that pretty much we moved down from, I would say, 18... let me see, what was the historical price? So I've been running some machine learning programs to I have to block that out. But I've been running some machine learning programs to see the price of gold. And before, I would say last week, we were on 1870 and pretty much on the 1870, 1860 range. And then today we are at 1805. It's a big drop for gold. We dropped, I would say, we did a 1 drop movement of $100 recently, like a few days ago on the Pfizer vaccine news. Then we did another big drop on the AstraZeneca vaccine news. And then, no, first we did a big drop on the Pfizer news where we were above 1900 and dropped below 1800. And then basically we got hit by a double whammy recently. And the reason why I know it's not because of the market action that gold dropped. It's not because of anything inherent to gold. It's because of external factors. It's because when I look at the machine learning models and when I look at the predicted prices, I can see a clear deviation between what the model is predicting and what the prices, what basically are the realized prices. And this is really clear in the 1-day prediction. Now, typically, I made the 1-day prediction model, and what I was surprised by was that the 1-day prediction model is extremely accurate for short-term predictions, right? We have close to 99% accuracy, and on average, we have an accuracy of 99%. But whenever there are strong news trades, we see the average drop below 98%. And today, at least over the last few days, we are seeing a 3% drop in the accuracy of gold prices. So what it tells me is that there's clear external factors that's influencing the price of gold, and that's influencing how gold is traded today, not because of market conditions, but because of external factors that have greatly shifted existing, I would say, existing market conditions into a new paradigm, right? So what do I think has happened recently in terms of news? Well, we were hit by a double whammy. And what are the 2 double whammies that would hit us in the market is quite clear. First of all, there is the AstraZeneca vaccine. And the AstraZeneca vaccine, so we see the gold prices tumble. This is not the right news article. Here it is, COVID vaccine news and beginning of the transition of Biden as the United States president. This is the reason why, the clear reason why the markets have fallen, especially for gold and silver. Now, people are wondering, well, why does gold and silver fall relative to this news? Well, because the corona vaccine news, especially the most recent one from AstraZeneca, you have to understand the difference between this vaccine and the Pfizer vaccine. I wasn't too... when the Pfizer vaccine came out, I don't think it should have affected gold's price as much as it did, but it did. And then we saw some slight rebound pretty quickly. It did not continue to fall over multiple days. The reason is because the Pfizer vaccine and the Moderna vaccine and all those vaccines are RNA-based vaccines. Now, if you read a little bit about what RNA vaccines are vaccines that have never been tested or used on human beings. They are vaccines that you inject and that modify your genetic material, and basically it modifies a few cells and it makes those cells produce the virus protein. The current vaccine is made by AstraZeneca, and it is a vaccine that's based upon known vaccine technology, right? We have vaccines made with the technology and in current use based upon the same technology for the AstraZeneca vaccine, and is much easier to deliver the AstraZeneca vaccine because it can be stored in a normal freezer. You don't have to run a dry ice supply or a dry eye business on the side to be able to deliver the vaccine. It's easily deliverable, and it's much cheaper too. It's a much cheaper vaccine compared to the Pfizer and also the Moderna vaccines. Now, potentially, this vaccine is also much safer because it's not on unknown technology. It's on a very clear, known type of technology that has been tested and used for many years on people. What do I think will happen next? Well, I think that they're going to roll out if the AstraZeneca vaccine is approved. I think it will be rolled out along with the two other vaccines, but it will be the main vaccine that will go around. And pretty much, we don't know how effective it is. They say it's 90%. Maybe we need more boosters and so on. And we don't know how people will react to it and so on. But I would say that, it's pretty clear a vaccine is coming. Does it mean that it's the end of the economic situation is going to improve immediately? No. But it does mean that there is hope for economic situations to improve, such as for they call them the recovery stocks, stay-at-home stocks also took a hit. The overall economy is pricing in that, the situation has changed. It was not sure that it would change, but it changed, and now we've priced in the change. The second thing that hit us is that Joe Biden was transitioned into the position as so what happened was, so he's not yet confirmed as a president of the United States. However, the federal office responsible for ensuring the transition of Biden, they've decided to release funds to prepare Biden and his team for the transition. They've decided to make available the documents, the federal documents, so that Biden and his team can transition. Now, they have issued in their letter stating clearly that they're not the people selecting the next president, but in the interest of the United States, they have to do basically what's best for the United States, which means that he is going to most likely be the next president. So they will release funds. And basically, it's not their responsibility to pick the next president. It is the Electoral College responsibility to pick the next president. And basically, he is not selected as a president, but they're making the funds available for him. Now, a lot of investors took this as, the government, the administration, and all the federal offices have accepted Biden as the next president despite what Trump does. So they've priced it in. Now, people are like, so why is it bad for gold if Biden and there's a Democratic government? Will it be bad for gold if they'll do so much stimulus? Well, the thing is, at this moment, like I said, if Biden's priced in, right, he is priced in as being, I would say it's not so much as Biden being priced in, it's rather a resolution of a conflicted situation. It doesn't matter who is the next president of the United States of America. It's more like, 3 days ago, people were fighting over, the election results, and they're like, oh, we don't know who's the next president. Think about it this way. If next year in March, there is no president in office, how will the markets react? Pretty badly, right? They're not going to react very well. And it will be sort of the worst case scenario for the markets. If there is a president running the country, it is a better scenario than having no president at all. It doesn't matter from which party. This is what the market is saying. It's saying that, okay, there's clarity in this situation, so we can move forward. So the stock market reacting to these two news combined is extremely bullish. The stock market went up nearly 2% today, right? AstraZeneca was yesterday. Today, it also went up. The only thing that hasn't priced in is that currently we still don't have the vaccine delivered, and we don't know when the vaccine will be delivered. And also Nancy Pelosi is holding up, Nancy Pelosi and Mitch McConnell are holding up the stimulus bill. Like these two people basically do not want to compromise a tiny single bit. And really, they don't care. I mean, both of them are dinosaurs and they're going to die, maybe in the next 3 years. So what do they care? I mean, honestly, they're fighting over this thing as sort of like probably like their last battle before they die. So, they're going at it and they're never going to compromise, those two. And then you have this group that's called the Problem Solver Caucus, which is composed of both Democrats and Republicans, and they want to, reach sort of at least a workable solution for the American people or the So this is, but they're not getting anywhere because the two leaders are not following them. So if you really want to know who's running the government right now, it's pretty much Nancy Pelosi and Mitch McConnell, and they don't get along and they won't work together. So there's that. And if that is being held up, then no stimulus is not really that great for gold, because gold, I would say gold's pricing, the long-term pricing, is related to monetary supply. And the larger the monetary supply, gold tends to trend upwards. But if you don't have stimulus, you don't have public spending, and you don't have monetary supply, then gold tends to trend downwards. And we're currently seeing that. And I'll go over some of the things that I'm going to look at. The second thing that has sort of happened, I would say, is, so this is Biden's news. And then the second thing that has happened is we have sort of the approaching of the 200-day exponential moving average. So basically, we see that gold, there is a sort of a slight upward trend for gold, right? But it's been quite a while since we are above this trend. Now, there are times when we came close to it, but most of the time we were above the trend. Now, the last time we were under the trend was in November 2018. And this was right after we came down, we broke through the trend, and we came down into a bear market for a while, and then we went back up again. Now, do I think that, we might go down? I think, we're approaching some buying opportunities, because if we look at the previous, sort of crossovers, right? The crossover was over a period of, I would say it was over 1, 2, 3, I want to say 1, 2, 3, 4, 5, 6, 7, 6, 7, 8, 9. Yeah, it was over like almost a month before we seriously crossed over the line. However, we did cross over. I do think right now it's possible that we're kind of in this situation, this formation that we saw in 2017, right? Around December 2017, gold prices tanks. It tanks about roughly the same amount. It tanks the same amount percentage over this period of time, maybe around, how much is it? $100 over 120, it's like 8-9%. Which is currently roughly what we've seen, a decrease of over 5%. We could probably see a crossover. I say right now is the start of a buying opportunity. You can buy a little bit and it's not too bad. And I would ease off if the price of gold goes back up, because most likely over the next few, I would say the next period, at least until March, we're not going to see stimulus. What I think the Democrats are trying to do, and at least what Nancy Pelosi is trying to make the Democrats do, is she wants to see the results of the Senate race before trying to negotiate a new deal. So she's going to try to put as much blame as possible on Mitch McConnell, and Mitch McConnell's do the same thing for Nancy Pelosi, and neither of them will try to negotiate a stimulus bill before the Senate race is over. And this is something that you have to take into consideration of how it will affect the economy. If there is no clear stimulus bill, it's just going to build up a lot of the spending problems of individuals. You're like, what do you mean by spending problems? What I mean by spending problems is that currently a lot of individuals are on sort of, I would say, life support, financial life support. And through no fault of their own, they're on financial life support because basically either they've been shut in, they can't go out to work, bars and restaurants are closed. You know, if you're a server, you can't work. If you're a chef, you can't work. If you're basically a caterer, you can barely work. You might get some orders. If you're a retail store, you have less foot traffic. You know, it's overall affecting the consumer economy. Now, if you don't have a consumer economy, people don't get paid, it affects the overall economy and so on, and it has a knock-on effect. So right now, people really depend on their stimulus checks to be able to meet their daily obligations, which means that they have living expenses such as rent, they have living expenses such as food. We're in winter, you know, you've got heating prices, you have to price in heating, you have to price in a lot of things. But without the stimulus check, it's not really possible, right? So people might decide to go more into debt. Now, if individuals start taking on more debt, not just governments taking on more debt, it makes the price of debt more expensive, which means that when the Federal Reserve will have to decide to do QE, they'll have to do much more QE than if they did it earlier. That means that if they did it, I would say like maybe 3 months ago, they were able to do more QE. There was a fiscal bill out, maybe even for like, I don't know, $2 trillion, right? That would solve the problem. What's going to happen is they're going to have to try, they might pass. Let's say the scenario. We have the Senate race. The most likely scenario out of the Senate race is there's a deadlock. There's a 1-to-1. They're basically at 50-50. And sort of there's a break even in Senate. Okay, we're going to get a more likely Democratic bill out. Okay, now, if they do a $2 trillion stimulus package and the Federal Reserve decides to stimulate the economy by $2 trillion, it's not even going to be close to enough to reboot the engine. They're going to probably have, because they've delayed it, they probably will have to spend double that. They're going to have to inject maybe $4 trillion into the economy by then. And right now they can't agree on spending $2 trillion. They're going to have to try and agree on spending $4 trillion, so it's not going to be enough. So they're going to try and agree always less than what's needed, which means that the Federal Reserve needs to constantly do QE and constantly meet this insufficient stimulus bill, because the government, it basically ends up being like what's in Japan. You know, they're constantly doing stimulus, but never enough, because the government cannot agree on sort of the exact amount of stimulus that that is needed. They're turning basically what is a sort of math problem into a political issue. And that's never a great thing, you know. If it's kind of like trying to have politicians decide when to fire a rocket into space, or design a rocket. It'll be a horrific decision, you know. It can't work. If you had a bunch of people, you know, who had common sense and basically didn't have, you know, political conflicts of interest, then you get more work done. I would say that's one thing. Do I think that right now, like if you look at the technical perspectives of how gold has been over the last few days, right? The massive drop that we've seen. This is a big drop. If you combine the drop from 1960 to basically 1800 is where we are at. I would say this is yeah, it's almost a 1915 to 1800 is almost a 10% drop. That is what I would call a gold crash. And it did it over the course of over a period of almost a month, right? From the beginning of November all the way until the end of November, we've had basically a gold crash. And do I think it can go further? I think that, okay, this is the part where the machine learning algorithms come in and sort of help me in my prediction. And I'm pretty happy like that it's correct. I'm not so happy, like, you know, if you bought before, I'm sorry, like I'm really sorry about your loss. But if you bought like, I don't know, 10 ounces of gold when it was at 2000, yeah, it's not great. But if you've been buying slowly, cost averaging in after the drop, you're not doing too badly. I bought some gold, I think at 1860. I bought a little bit at 1818. I bought some right afterwards in the 1900s. Yes, it's less. I already bought some more gold already. It's a buying opportunity. You should ease in a little bit. It's potentially we can see further lower gold points, right? Will it ever default or go to zero? No, gold doesn't do that. You can't do that. Especially the fact that it's used as money to settle international. It can be used as money to settle international trade and accounts. It's a tier 1 asset. That means your banks can hold it and use it to trade for collateral with a central bank, use it as collateral to trade for cash with a central bank. It's got enormous monetary uses. I know if you read like Warren Buffett, he'll tell you that, gold has no utility. Gold has utility. Gold's utility is that it can act as a supranational currency and collateral for banks and institutions to take out more liquidity in their own nation's currency without having to depend on another government. That's the utility of gold, in the sense that it is money that's absolutely neutral. which is you're like, okay, something that doesn't do anything is actually kind of useful. Now, are we in oversold territory? Some of the technicals say that we are approaching oversold territory. This is what I want to point out. We've moved down very, very quickly. If I look at sort of the 14-day RSI, we are at the bottom of the 14-day RSI. Right now, I'm looking at periods of, I believe, the 14-day RSI is just RSI 14 periods, and I'm on the 1-day chart. So we are 14 days into into the RSI calculation, and basically it's the RSI. If you want to know what it means, it's basically the average of all the upward movement percentages divided by, no, that's not. So first you have to calculate the relative strength, and the relative strength is the average of the upward movement percentages divided by the 14 periods, and that divided by the downward is average down divided by average up divided by the periods. Okay, and it's in percentage values. So then you get a value. Typically that value is slightly less than 1, I think. I have the formula. I use the formula in my code. Let me see. I have it here in my gold data, and I go into gold ML, and I have RSI. I calculate the RSI because I did this yesterday, but I've been doing a lot of calculations. Let's see. RSI. I am. Here it is. It is the average sum of the average gains divided by the 14 period plus the sum of the losses. These are percentage divided by the same period, and this gives you the relative strength of the period. To create the index, you have to do 100 minus 100 divided by 1 plus the relative strength. This value is typically slightly bigger than 1, so this value will be less than 100 usually, and the relative strength is the relative strength of the upward momentum, not of the downward momentum. So when you are in oversold territory, you are typically very high on the RSI. So the RSI goes from 100 to 0 based upon this calculation. Can't go above 100. And if you are relatively weak, that means there's a lot of sell-off. The sum of the gains is very low, so obviously the RSI will be relatively low too. So what does that mean for the value here, right? Are we in a buying position? Should you be buying gold? Well, let's take a look. The RSI, when it dropped to 1905, was actually not super low. It was only 50. The RSI, when it dropped to 1858, was pretty much at 35. The RSI, when it drops to the point it is now, is almost 32. Now, if you break below, like any point that goes below 32 is an extreme buying opportunity. You can see here that in this period, right in the period in August 2018, when gold was probably at its lowest point, the RSI is sub 30. Now, it has not crossed the lower 30 level since then. If you have a massive crash and it goes to such levels, it means that, it's a great buying opportunity. Now, if the RSI crosses over, right? If we see over the next few days, the RSI crosses down way below the 30 level, I would say that's a very good buying opportunity. Right now, we are going towards it. Will we cross the 30 threshold to create a clear buying opportunity? Maybe. Another point I want to make is the last time we were so close to the 30 level was during the massive crash, right? Basically, RSI is a relative strength of the change in price. And right now, it's pretty clear that we are in a dip right now. And in this dip, should you buy or not? I think you're relatively safe, if you buy a little bit in. And there's nothing too much to worry about. However, I do have to point out that based upon, I would say, the midterm projections from the machine learning program, it does believe the same thing, right? It believes that right now, for example, today basically this is based upon information from yesterday, at 1837, because of such a low RSI, we are going to potentially see a rise in the price of gold in the next 7 days. It's projecting around 1846. I'm not too sure it's going to go up to 1846, but I think that we're going to see a slight rise in the price of gold. I think that also when I do the 22-day learning day model, it does predict that the price of gold, so this isn't perfectly accurate, it will be around 1815, right? It doesn't predict that it's going to drop much faster. Like right now, we have a huge drop from 1871 to 1837 on Monday. But it does not predict that it will have a more powerful drop. It's predicting that it might drop from the 1837 level, but the speed at which it drops is not the same. That's because here it's almost like a 1.5% and it's 1.2. So I think the speed of the drop is going to slow down, and we're going to see more of a slowdown in the speed of the drop, but it could trend downwards. And in terms of the long-term prediction, so I have the 112-day prediction, and it believes, based on current factors, if we continue down the same path, we are going to see a trend downwards in terms of the price of gold. Now, I usually get the price, the closing price, and it bases the calculation based on the closing price. So until I have the closing price, I don't have an exact calculation for what's the prediction for today. And I've been running it over the course of the day for a few times, and I'm pretty much getting numbers above 1630. So if we are to go on to, let's say, the third of if we go into March next year, the mid of March, the Ides of March, and we are, let's say, in the same situation, right? The economy we have more, let's say, positive factors for the stock market. We see that the stock market is booming, that companies are not going bust, many less companies are going bust. People are, people are not so much in debt. There's no debt problem, and government can agree on bailing everybody out really early, really fast. Then yeah, I think we will see 1600 prices of gold by next March. That's very possible. However, if we don't see those things, that means that sort of the signals are a bit mixed. That means that we do see that people are getting back to work, but not as much as we expected. But people are also very much debt burdened, and there's more defaults than expected, but not as much as we would have that would cause a catastrophe. Sort of the middle of the ground. I don't think gold will go down to 1600. I think we'll stay around the 1750 levels, or maybe above 1750, maybe around the 1800s. So if today you're going to buy a little bit of gold, let's say you buy one sovereign for around, let's see, what would be the price of a sovereign today? The price of a sovereign today would be roughly, I think it would be $440 if you're able to get a good deal on it, or a Swiss franc at around $330, $340, 20 Swiss franc coin, I think it's a good deal. You know, it's most likely your dealer will not go lower for his physical gold, because you have to remember the last time we saw that price was around July or a bit before July. And your dealer needs to make his margin. If he acquired gold back when it's June, July, most physical dealers are not willing to sell their gold for less than they acquired. Especially that's a bad way to do business. And unless they have to, and unless they have to make a liquidity. What you might see is that physical gold is actually a little bit more expensive than, I've been seeing this. Most of my dealers, they have automatic corrections, especially the larger ones, for the price of gold. And what I noticed today was it took a while for all of them to update their prices. Like most of them, I think, have stop measures for the price drop. So some of them are automatic until a certain point. I've seen at one of my dealers, he took off all his like on sale signs for all of his gold and removed all the discounts he was giving on certain pieces because the price dropped too much, and he had to adjust his prices. But by adjusting his prices, he couldn't do sales anymore. So yeah, so he had to like sort of limit it at a certain point. Do I think the 1800 level is a resistance level? Yes, I think there are more buyers around the 1800 level. I didn't think we would approach the 1800 level so quickly. I thought that maybe we could see like further trending downwards over the course of maybe until Christmas. Like we would see like by Christmas we'll hit somewhere around 1750, and I would buy like a lot more gold. But we're going down much faster than I expected. Actually, it goes against some of my predictions that we would see a bear trend. What might happen is after this we might see some upward movement starting, I would say, the end of the year, just as a reaction to the current downward movement. Not so much because the fundamentals have really changed to change the downward trend. And if we break this like 200-day moving average point, you know, it could go even lower, but it could also mean that it's a point where we can see that it goes up higher. Right now, I'm seeing that it's just holding at that point. Does it mean that it will go lower? Possibly. No, nobody has a crystal ball. But I do have to say, if we are on the same fundamentals as today and we have the same frequencies of the improvement of the economic situation, that means that, you know, right now, I would say from the period of August until now, we've had relatively little bad news. We've only had good news. Like we've only had, oh yeah, the economy is recovering. The Fed has bailed people out. There's stimulus checks coming out. There's an election. There's stuff, you know, but none of it has been bad for the stock market. Everything has been positive in terms of news for the stock market. But people pretty much just ignored, like, for example, the quarterly earnings. The fact that, you know, I was reading some of these quarterly earnings, people are like, yeah, over 100% expected earnings. You look at the company and it's earning 2 cents a share. You're like, wow, yeah, if you were expecting 1 cent per share, yeah, of course it's a 100% increase. There's this sort of euphoria in the market that in normal times, if you take a look at these numbers, I would say like last year, if you took at the same numbers and you look at them and you look at the market, you're like, why isn't the market like 40% less than what it is right now? It also goes back to me like thinking, you know, I was talking to some people about Tesla and they're saying Tesla's a great buy. And I said, yeah, but who's going to buy cars right now? You know, especially a new car, especially the fact that, you know, people have reduced earnings. They're not going to make those. If you haven't worked over this period, you're not going to make up, you know, your work. You have been out of work. You've been on reduced income for quite a while. So how are you going to buy a Tesla? I mean, that's another point. And also, if you are sort of this, you don't depend on stimulus check. Your business is still in business, right? Sorry, notification message. Your business is still in business. What do you, and the most likely thing that will happen, I know for a lot of people that I know, especially who depend on bonuses, they're not getting any bonuses this year. So For sure next year, in the beginning of next year, we're going to see reduced spending. Because right now, yes, they're spending what they have, but these are they're spending based on their savings. And once they don't have those savings and once they don't get their bonuses, they're still going to have to pay taxes next year. And their taxes are not based upon like this year's calculation or this year's earnings. Most likely your bonus goes into next year. You receive last year's bonus in this year. And sometimes, you know, some people, because they receive it quite late, they have to pay their taxes next year. Now, if they had to use that money, so all of a sudden, I suspect like coming up to next year, there's going to be a lot of sort of backdated expenses that people have put off, but that are going to catch up to them. And that will cause a consumption issue, right? Even if you reopen the economy, people might not be willing to consume as much because they don't have the available funds to consume as much. And it doesn't mean that they're going to save more. It just means that you're going to have a downward trend for the overall economy. And that is something that I think no market is priced in right now. Everybody is expecting that the markets will reopen and everybody will spend. But people forget that people haven't been earning a lot during this period, but they still had to spend a basic amount of their income on just being alive. Like I tell a lot of my stackers, you know, you are a living, breathing, I tell a lot of stackers, you're a living, breathing person. You've got fixed cost expenses. Don't go over them. You can't ignore the fact that you have to live. And you can't just like, you're not a gold bar. It doesn't work like that. So yeah, do I think we'll see further downward movement? I think we could see further downward movement. If I move to the 1 hour period, we're below the 200. You know, it's clearly saying for the last hour, you're in buying territory. You should buy. It's pretty much stabilized around $806. I've seen this. It's dropped quite a bit over the 1 hour period. But we are seeing a lot more buyers at the 80 above 800. We saw more sell-offs this morning. Like I've seen that most of the sell-offs happen in the morning, and then later on you have some people who have a little bit more risk appetite and they're like, yeah, it's not too bad. We can see that, you know, it's quite down. We can buy a little bit, but there's not so many people saying, oh, it's a great market and we're going to order and buy the house. No, I think overall people are looking at this situation. They're trying to wondering like how much more volume is going to be sold off. Because if we look at the total amount of volume, there's quite a big move in the volume. We see that there's a lot more buying activity. And if you're thinking now they're shorting the market, pretty much we've shorted, I would say about 20% of what was bought over the last, how much is this? The last 1, 2, 3, 4, 5, 6, 7, 8, 9 days. I would say with this is pretty much they shorted what was bought up over the past few 9 days. Do I think that we are going to go lower? I don't know. It seems that, you know, the speed at which we go down has slowed down, but also because we're approaching Asian market opening hours, and most likely we might see like some of the market pick up a little bit and we'll go back up to maybe 1815. 1812 over the next day, and then it's going to drop back a little bit, probably to around 1800, 1790, somewhere around there. That might be another buying opportunity. You're going to see it just like stay a little bit above like the 1780 level, I would say, and just hover around between 1780 and the lows between 1780 and 1800. Does it change anything if you're stacking for like the long term, 30 years? No, it doesn't change it a bit. If you're stacking, it just means that right now, before Black Friday, you can buy gold cheaper. I call it the Black Friday sale. So yeah, Black Friday sale, gold, 5% discount. This, you can see it like that. That's one way to see it. Gold goes on sale on Black Friday. Possibly by Black Friday, we are going to still see 1805. And just means that you got a Black Friday sale for stacking. That's a great thing. Thank you very much for watching. If you like the content, please click a like. That helps me out a lot. Leave a comment below. You guys are really funny to talk to, and it's always good to share stuff with other stackers. Thank you very much for watching. Like and subscribe. Dave out.